I think one thing that this past filing season has taught us is that tax practitioners are very adaptable. All the members I've seen have learned so quickly, and they're so curious to understand just to be able to serve their clients better. So that's been amazing to see, but I know they're tired.
Hello and welcome to Simply Tax. It's Wednesday, November 18, 2020, and while conversations around tax policy have shifted to a bit of a wait and see pending the runoff elections in Georgia that will determine which party will control the Senate for the next 2 years, as we've discussed on previous episodes of the podcast, the prospect of tax change isn't the only tax thing to think about these days. On the podcast today, I'm excited to share with you a conversation I had with Amy Wang, a senior manager on the AICPA's Tax Policy and Advocacy Team, as she returns to the podcast to share an update on what's happening in Washington these days with PPP loan forgiveness and many other tax areas that the team has been working on in a year that's been packed with twists, turns, and tax legislation and guidance. Let's jump into the conversation with one of the top questions I've been fielding lately. What's the latest in Washington, and what are you hearing on another round of relief?
People all want to know about the next round of relief, and we've been following it very closely. Clients and members asking about PPP expense deductibility or round 2 of PPP provisions. And what we've heard is that it's not going to happen, and we think it's not going to happen until 2021, after the election, after new Congress. And actually, the rumor we've heard in D.C. is that what's stopping it is Treasury Secretary Mnuchin. So Congress has already written a public letter, saying this is our congressional intent, that they want expense deductibility of forgiven PPP loans. And they've pressured Treasury, but we've heard it's just Secretary Mnuchin is pushing back very hard.
I guess it was outlined in the notice and the position, and that's what the statute says, and we don't have the ability to do that. Is that essentially what you're hearing?
Yeah, that's essentially what we're hearing, even though we've gone to Congress and said, hey, let them know this is your intent. This is what you meant when you wrote the law. So we'll just have to wait and see. So we're really advocating hard. We've submitted more than 4 comment letters. They've already introduced the language. We just need a bill to pass.
I mean, really, phase 4 negotiations started back in May, I guess, right? With the bill that was passed in the House, and there's been a lot of back and forth since then. And there's many pieces to that beyond just the PPP and the deductibility issue. Any sense for that, again, I guess, to get things reconciled here and see something?
We saw the HEALS Act, and then every time we see new legislation come out, we see if the provisions that we're supporting are included in the language, and we keep seeing things. It'll be in one version, and then it'll be out in another version.
Okay, so aside from a possible legislative fix of the result in IRS Notice 2020-32, with Congress interceding to address the deductibility issue, which, as Amy indicated, is the AICPA's top priority right now, and they support the language included in the Small Business Expense Protection Act of 2020 in the Senate, where do we stand on PPP deductibility? Having just moderated 2 two-hour panel discussions for BKD on tax planning for individuals and businesses in 2020, which, by the way, you can find links to the recordings of in the show notes of this episode, I can tell you questions regarding issues related to overlapping tax years or expenses paid in 2020 and forgiveness granted in 2021 are top of mind for many right now. The latest Amy and frequent podcast guest Ed Carl have heard is that the Treasury has plans to issue guidance before the end of the year and possibly before the end of this month that's expected to provide a deduction is not allowed in 2020 if there's a reasonable expectation of forgiveness in 2021. Okay, it's Thursday, November 19th, and I'm going to interrupt myself interrupting here with a post-release update to say that the guidance that we were looking for that I just talked about dropped late in the day on Wednesday, November 18. As expected, Revenue Ruling 2020-27 generally provides if a business reasonably believes that a PPP loan will be forgiven in the future, expenses related to the loan are not deductible, whether the business has filed for forgiveness or not. The IRS also simultaneously released Revenue Procedure 2020-51, which provides a safe harbor offering some welcome flexibility for taxpayers that file 2020 tax returns, treating expenditures as not deductible, but later determine they are deductible, say if they have the forgiveness amount partially or fully denied. While the guidance does provide some clarity on the IRS's position on deductibility of loans that aren't yet forgiven at year-end, there remain unanswered questions on what the IRS would view as not meeting the reasonable expectation standard, particularly for borrowers with loans over $2 million subject to review based on the economic necessity criteria. Back to you, yesterday version of Damien. The bottom line here is that there are many great minds in the tax world right now that are reaching different conclusions based on where we stand currently, so it's a bit uncertain. As a result, it would seem the prudent and practical approach is to wait and see what's in the forthcoming guidance and to extend tax returns in the meantime. As Amy mentioned, the AICPA's Tax Advocacy Team continues to push for guidance and has communicated directly with Treasury and the SBA, asked state CPA societies to join the push, and are working directly with members of Congress to take action as taxpayers need more information to make critical decisions about things like staff retention, staff rehiring, and the allocation of loan funds. The result so far has been that we've heard members of Congress speak up publicly on the need for guidance, and they are also reaching out privately to Treasury and the SBA to push for more information. And of course, as I already mentioned, legislative action here would make this discussion moot and would take care of the issue altogether. And speaking of PPP-related action in Washington, there's one last thing I'd like to mention here. There continues to be broad bicameral support for simplifying the loan forgiveness process to allow PPP recipients with loan amounts under $150,000 and those with loan amounts between $150,000 and $2 million to use a streamlined application process. And we saw language included in the HEALS Act and the skinny version of the HEALS Act that would accomplish this, though neither have made it through the legislative process so far. The AICPA has also called on the SBA to simplify the process by creating their own calculator or to certify a third-party calculator such as the one created by the AICPA to assist loan recipients with the calculation of loan forgiveness. All right, that's enough from me on PPP. Let's get back to the interview since there's much more Amy and her team have been up to lately. The IRS probably has an unenviable task of, getting guidance out really from the Tax Cuts and Jobs Act, as you mentioned, and then kind of hard-turn CARES Act and FFCRA and all the other pieces that we've seen. I guess what's that been like from your perspective? Obviously, I know that the AICPA and the advocacy group is so involved in that, and oftentimes really in advance of things coming out. But the turnaround's been so quick. What's the experience been like?
We're set up as technical resource panels and committees, TRPs, and all our groups we're in different sections. So I manage our individual self-employed and our international, and my colleagues, we have an employee benefits TRP, exempt orgs TRP, tax methods and periods, S-corp partnerships, and each group has been trying to juggle both FFCRA, CARES, and also the proposed and final regs coming out from TCJA. And we're trying to just juggle it and take care of it and prioritize what's most important. So I know from my international group, we are still drafting comments on GILTI, and we're still monitoring OECD and digital tax issues. But at the same time, we're trying to deal with NOLs and carrybacks and things that have come on the plate as a result of CARES.
I guess when I think about it, my takeaways, right, back when we were talking, 2017 tax reform and all that was, there was a simplification underpinning to it, but we kind of added a number of things and we're kind of stacking on a little bit more here. I mean, so there is a lot to think about right now. And obviously, despite all that, I mean, the service did manage to get a good amount of guidance out and finalized guidance kind of late summer, early fall here.
And not only that, but every package they were putting out was like 200 pages, 250 pages, like 163J. At some point, we were like, please do not release this right now. We're not ready for 163J. And of course, they released it. So now we have a joint TRP task force just working on it. So we're going to submit, we're planning to submit a joint comment letter from all the different areas. So international, partnership, S-corps, exempt orgs has a comment in there, individuals, and there's some trust estate issues as well. But yeah, the reg packages, and they're significant. It's a significant amount of detail to read through.
It definitely is, and I will agree with you. I think because it was like the last week of July, I think that it kind of came out there. And I'm just thinking to myself, oh my, like, yeah, I'm not ready for this right now.
And that was the issue because our members were dealing with COVID-related returns, delays, extended returns, and then we had the 163J regs, and they give us, I think it was it's like a 60-day comment period, which is not enough time because they spent 2 years putting the regs out. Mm-hmm. We don't have enough time in 60 days to read everything and understand the issues and respond. So some of the things that I guess I could share with our advocacy efforts and what we're focused on right now.
That'd be great, yeah.
So we have a pass-through GILTI letter that we're working on, and that's, partnership, S-corps, and international. We're also working on the 163J. We've already decided on what the issues we really want to comment on, and now we're in the drafting phase of that. Also, on top of COVID and everything that happened this past year, we dealt with disasters. So all the hurricanes along the South, the fires in California, and with all of that disaster relief, the AICPA has always been working on advocating for permanent tax disaster relief. So we saw that problem happen again this year, where the disasters happen around, because hurricane season is right around extended filing season, so September, October. And what always happens is those disasters occur right before a filing deadline. And the IRS, right now, their current procedure is they're not able to respond quick enough to offer filing relief. So you have people who have evacuated in Louisiana, they've evacuated in Alabama, but practitioners have a deadline in 5 days, and they're like, you need to tell us what's going on. Please give us relief so that I can leave my office, I can leave my papers behind, and I can tell my clients that we have an extension. And there's a whole process that goes through between the state declaring a disaster declaration to FEMA declaring a federal disaster declaration to IRS finally offering that relief. And that lag in time can be, 1 to 2 weeks or longer. And it doesn't work for our members, for practitioners. So that's something that we continue to work on. And I think we're going to push for even harder in the new year with the new Congress. Some other things, I know that you plan to speak with some of my other colleagues in upcoming podcasts, but our tax methods and periods group, they have worked really hard on priority TCJ and CARES issues, and they've submitted a few comments on that. Also, a project that we've been working on for a long time is mobile workforce, and that was something we always advocated for, so that CPAs can move from one state and work in another state and have kind of a simplified way of reporting that. And with COVID, everyone has left their home states and moved around or gone to other places. So we've been working on providing comments on legislation that supports imposing a single national standard for traveling employees, and just simplifying that process and that'll help CPAs as well, who end up having to track all of this.
Absolutely, yeah, and I know I've heard a lot of concern about that. To your point, because it's this situation, the environment that we find ourselves in, and so many people working remote. To your point, and sometimes in different states, it really complicates things, and it creates some uncertainty without a doubt.
Yeah, and not only does it affect practitioners who have to do all the tracking, but right now you have traveling medical and support workers that are traveling all the time for COVID. Like, why do we need to add on the administrative burden of tracking how many days you were in each state?
Right.
It's just too complex. And then one other big project that my colleague Melanie's been working on is IRS guidance on the e-signature program, which the IRS has been expanding. It was tough to get them to broaden that availability of e-signatures for COVID purposes, because they really hold those things tight, and they're fearful of fraud and bad actors. But we've pushed for that, and we told them this is really important. We can't have all that contact of clients coming in to sign paperwork. This is the time to make e-signatures work. So we've been advocating for that, and then also just other COVID-related filing and penalty relief.
And obviously, there was the backlog that the IRS had, and that they shared publicly that there was things sitting in trailers because of the difficulty in opening the mail. So there's certainly going to be some issues there, I would expect.
Absolutely. And with that backlog, what we heard, so there was about 11 million returns we heard sitting in the trailers. And then last we heard, I think it was down to 5 million, but we're not sure if that means that, the other 6 million has just been opened, or have they all been closed, dealt with, or they've just been opened.
Right. It's hard to know, right? And again, I know it puts them in a tough spot for sure, but it also puts taxpayers and tax practitioners in a tough spot, clearly. It
does. And GAO had a call with us, and they wanted to hear from us and our members about how tax filing season has been and how we've dealt with executive orders, CARES, FFCRA. And one of the things we shared with them is it's not just guidance issues or things related to new legislation or delay in refunds or delay in opening the letters. One big thing is the NOLs. They're asking us about how have we been able to take advantage of the CARES provisions, but we're saying even just NOL carryback, this is a huge refund for businesses that could really use it. And it's a big number, much more significant than some of the provisions in CARES offered to businesses. And they're just sitting, waiting on the return.
That was the idea behind the provision, right? Was to allow this ability to get the cash flow back into businesses by carrying those losses back. And I've heard that from taxpayers that are looking to get that accomplished. And you just kind of have to say, well, you have to wait until it gets processed. So yeah, hopefully and I know there's been some improvements in, rolling out modernization with the ability to electronically file certain amended returns and things like that. And it all takes time, but
Yeah.
it is challenging, no doubt.
Yeah, it takes time, and there's always a trick to it. Like when they started allowing you to fax it in, there's like a 50-page limit. So then we didn't know when you have those significantly large returns that are over 100 pages, those still need to be paper filed.
Interesting is probably the best word to describe it. The whole season was kind of interesting, and I'm sure you're hearing that from members as well in terms of just taking it all in, right?
Absolutely. I think our members have shared that this is the toughest filing season they've ever experienced.
Definitely took its toll. And I think even for those that were coming into the profession, I know I heard that quite frequently. And those that I work with just kind of feeling like it wore you out, more so than even just the really kind of the normal busy season, because I think it went on for so long.
Yeah, absolutely. And I think one thing that people in DC, the lawmakers, don't always remember is that we don't just deal with the federal return, there's state returns as well. So even if we had relief on the federal side, there were states that were saying, well, we're not extending because we need the money. Their departments of revenue needed the money.
Right.
They're like, we're not coupling with these extensions. And that was a struggle as well.
So what have you found to be some of the issues that are most frequently asked about or questions or issues are coming up from your perspective?
Yeah, great question. So I would say, and we talked about it before, but the top question we're getting is about PPP expense deductibility and how to deal with it and all the new issues that are popping up with timing and when to expense it. For that, we are just telling our members is that what we've heard is that a lot of members are waiting until they hear more guidance and until we see legislation, because we are expecting, for legislation to pass. Other than that, I think just on the state side, I think a lot of people have questions on state returns and things that states haven't caught up to yet or haven't coupled yet with federal. So we partner with a lot of the state societies to kind of help them and answer questions and see what they can advocate for on their state end. But also a few other ones that I think we have a lot of open questions about are the employee retention credit, the employer tax deferral, so all of those.
Yeah, there's definitely, anytime you get new provisions added in, obviously it takes time to get the guidance out and really understand where some of the issues are. So I'm curious, because you mentioned a lot of the areas, and I'm be particularly interested to see that when that 163J comment letter comes out, because I like that approach, because it touches so many different aspects. Like you mentioned, even exempt organizations, and so you really kind of have to take almost that holistic approach to thinking about it. But I'm curious, though, some of the advocacy efforts that you and the group have been doing, what have been some of the outcomes? What have been some of the, I guess, benefits, we'll say, of your work?
Yeah, that's a great question, because we're always excited when we get excited, even like one word changes on a draft form, and we're like, oh yes, they changed that word. This is a success.
Right.
Because progress is slow here in DC. So a few of the big ones that I think we really saw over this past year with regs that have come out. One of them is that the IRS adopted AICPA's recommendation that charitable contributions to Section 170C organizations aren't business expenses under Section 162. So we saw this on the latest draft 2020 QBI form 8995. And this was something that we recommended, and we now see that there's no requirement to reduce QBI by charitable donations, which is great. And the draft instructions for the form also include the worksheet that provides a reasonable method to track and compute previously disallowed losses or deductions to be included in QBI calculation for the year allowed. That was a big win for us to see that change on the draft form.
I was excited about that one as well, because that one, it just kind of bugged me. And I actually thought the comments there that were provided is saying that I don't think that's really the case. So it was great to see that was confirmed and cleared up, and the advocacy efforts had the direct result there of getting that removed from the instructions. So that's great.
Yeah, we were surprised to see it. We saw the form and someone was like, is that not there anymore?
It's kind of quite subtle, right? It's kind of a quiet victory,
Another one it affects some members is proposed regs on UBIT siloing. And we made recommendations, which were reflected in proposed regs, supporting the intention that an exempt organization's investment activities should be treated as a single trader business, and that taxpayers should be allowed to use the highest level of aggregation that reasonably defines a given trader business. and comments from the exempt orgs group, and they have been asking for this.
Well, that's also good news. Again, and kind of how to apply that provision definitely can be onerous, I guess, and can be challenging,
especially for charities.
Yeah,
to be able to deal with that. Yeah, another one is the CARES Act technical correction on qualified improvement property fix, the 15-year property. So we recommended that Congress provide a technical correction to the property class life on QIPs as 15 years and the inclusion of quality improvement property as eligible property for 100% bonus depreciation. And that was included in the CARES Act.
Yes, and that was really great news. And it's making, I'd say, a huge difference. And sometimes, and again, with that carryback opportunity with the NOLs under the CARES Act, I mean, that really is a big opportunity to look at. And that was definitely good news. I wasn't necessarily expecting that to get in there. I was really happy to see that as well, I guess, just from my personal practice perspective. Yeah.
It's good for businesses. And then another one, this is international side, the final FDII regs that came out. We made a recommendation that was reflected in the final Section 250 regs released in July regarding situations in which individuals may make a Section 962 election on an amended return. And then I know you wanted to also talk about what are some areas that we want to focus on as we head into the year end. Since
Absolutely.
We've got 2 months left.
Right.
Of course, we've got these pending projects, but also we're constantly monitoring what we're hearing on the Hill, and we've been really focused on the Biden tax plan, or what we know of it, and we've started our lists. All of our committees have been asked to start lists of what we're monitoring for those groups. And what we know right now is President Biden's plans would roll back certain provisions for higher income individuals, like the Section 199 Cap A pass-through deduction. Also, in terms of estate and gift tax, President Biden has stated that he would eliminate the favorable step-up in basis for transfers of appreciated property at death. And he also said that he would raise estate taxes to 2009 levels.
You kind of alluded to it too, right? I mean, they're proposals, and I know I get a lot of questions about the specifics of, how is this going to work? This aspect of Biden's plan, explain to me the basis step up and how it'll work in practice. And I mean, I guess my general response is, well, it's we're in bullet point form right now. We're not in legislative text, in the conversation. But I guess how would you respond to that when you look to some of the details?
Yeah, I think we do the best we can to predict what could happen and also to be prepared for it. But also, we're curious too. We're coming into our fall meetings, our committees, and at our fall meetings, we have Treasury, we invite IRS, and we invite them to come. And one big question we have for them is, if there is a shift or there's a lot of new tax legislation that passes after the election, how is Treasury and IRS planning to use their resources or to shift gears to quickly modify guidance and get the guidance out that we need for new tax proposals? Are they prepared for it? What is their plan for it?
That's a really great question, and I'm sure another challenge. I mean, it has been a challenging year again for really everybody. I mean, it's I don't think there's anybody that really hasn't been affected in some way, shape, or form by the current situation. But I mean, the IRS obviously has really had a lot in the last couple of years to contend with, and this year is kind of taking the cake almost, I guess you'd say.
I still get emails about, whatever happened to Section 461L and where's the guidance on that? And our answer is, I think the IRS is overwhelmed by what they are working on. They've had to shift gears to COVID-related guidance, and I think there's just not enough resources to, work on some of the things left over from TCJ at the moment.
So and I guess I'm kind of curious, and maybe you've alluded to it, of kind of, where the team and your group is going to be spending and focusing your efforts kind of going forward, because obviously we've got some uncertainty here. So how does that look? Because you're oftentimes years ahead on some of these things and watching them develop, like when it comes to the OECD and like you mentioned, that project and virtual currency and all of those. I mean, those are things that you've been working on. What happens now? What's next? Yeah,
we're going to keep doing what we've always been doing, which is keeping our hands extended in every single project. And then we're going to continue commenting on proposed regs, final regs, draft forms. One other thing is we always have, so 3 times a year, we have a Washington tax brief, and it is a free webcast for members. They can just join us. And I think you also get 1 CPE credit now. And you can join us and hear all the updates, the projects that we're currently focused on, and the updates of what we're hearing on the Hill.
I guess before we kind of wrap things up here, any closing thoughts or things you would leave everybody with?
The best thing I could say is If you want to stay updated, we have the Washington Tax Brief. We also have a PPP resource page, which I can share the link with you. And any of the latest updates that we have, we will be sharing on those web pages. And I know our PCPS team also has a bi-weekly town hall where they talk only about PPP loans and SBA updates. So we have a lot of resources available if you're interested in them.
I know that you mentioned a couple of the different projects that have been worked on, some that are being worked on, some that will be worked on. And I know we have a couple interviews that we're going to get lined up here to do that with the team and kind of dig a little deeper on some of these things, maybe like the 163J and the foreign partnership reporting, things like that. I think that would be really great to learn a little bit more about what's in them and the issues that the group's raising.
Absolutely. There's definitely a lot more that my colleagues are working on that I didn't even get to touch on today. Like you said, the draft K2, K3 forms. We've been working with the IRS closely on that. So happy to talk more on those issues.
Amy and the AICPA team do a fantastic job of breaking down everything going on in the tax policy and advocacy world with their Washington tax briefs. And you can find the materials from their latest brief on November 12, 2020, as well as learn how to sign up for future Washington tax briefs using the link in the show notes of this episode, which are available at bkd.com/simplytax. I'm excited to say this was just the first of a number of conversations with insights from the AICPA tax policy and advocacy team, just like the one you heard from Amy today. And we'll start with a conversation I had with Melanie Lauritsen on the advocacy efforts regarding COVID-19 filing and penalty relief, as well as the guidance on the AICPA electronic signature program. You can learn more about Amy, the AICPA, and get links to the resources mentioned in the conversation today in the show notes of this episode available at bkd.com/simplytax, which is also where you'll find an archive of our episodes. I really enjoy feedback and would like to hear from you. Please drop me an email at simplytax@bkd.com or reach out on social media to let me know what you think. You can find me out on Twitter at Damien Martin CPA, on Instagram at TaxDad, and out on LinkedIn. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.